Ladies and gentlemen, Asian guy here. I am here to tell you that the figure you see on your display is the least significant development that occurred today. If you're fixated on $79, you're missing the signal entirely. You're examining the scoreboard while the stadium is engulfed in flames, because the real story today isn't a numerical value, it's an identity, and that identity is Elon Musk. While we were monitoring the charts, while the algorithms were battling over fractions, one of the wealthiest individuals on the planet, the CEO of Tesla, the man who commands the largest solar energy corporation on Earth, went on X, formerly Twitter, and published 4 simple words that have altered the trajectory of this market permanently. Responding to a report about the silver shortage, Elon Musk wrote, "This is not good. Silver is needed in many industrial processes." Now, to the uninitiated, that sounds like a casual observation. "This is not good" sounds like a remark. But you have to comprehend who is speaking. This is not a hedge fund manager discussing his quarterly compensation. This is not a CNBC commentator trying to generate clicks. This is the man whose entire empire, from the electric vehicles at Tesla, to the solar panels at Solar City, to the electronics in SpaceX rockets, operates on silver. Silver is the most conductive metal on the periodic table. It is not optional for high-tech industry. You cannot construct a high-efficiency solar panel without silver paste. You cannot build an EV battery management system without silver contacts. There is no substitute that performs as well. Physics does not negotiate. So when Elon Musk says, "This is not good," he is not discussing the quotation. He doesn't care if silver is $79 or $100. He has billions in capital. He can afford the cost. What he is worried about is availability. "This is not good" means I am concerned I cannot obtain the metal. "This is not good" means my supply chain is at risk. "This is not good" means the paper market is lying and the physical shelves are empty. This is the moment the narrative transforms. For the last 5 years, we have been fighting a financial war. It was the silver advocates versus the banks. It was the retail investors versus the shorts. It was a game of paper leverage, margin calls, and short squeezes. We wanted the quotation to ascend. They wanted the quotation to descend. It was a casino game. But as of this morning, the financial war is over. The industrial war has begun. When the largest industrial consumer of silver on the planet publicly acknowledges a shortage, we move from speculation to survival. Tesla cannot print silver. They cannot derivative their way out of a shortage. If they don't have the physical metal, the assembly line stops. If the assembly line stops, the stock crashes. If the stock crashes, the empire wobbles. Musk is effectively short physical silver. He is short in the sense that he needs it and doesn't have it. And unlike a bank that can settle in cash, Musk must settle in metal. Do you understand the difference? If JP Morgan is short silver and the quotation goes up, they lose money. They write a check. It hurts, but they survive. If Tesla is short silver and the supply runs out, they lose production. They cease to exist as a functional manufacturer of future tech. So when Musk tweets, "This is not good," he is signaling to every other CEO in the tech sector, to Tim Cook at Apple, to the CEO of Samsung, to the battery giants in Korea, that the scramble is on. He just fired the starting gun for massive corporate stockpiling. Before today, these companies operated on just-in-time inventory. They kept a few weeks of silver on hand because they trusted the COMEX. They trusted the London vaults. They believed that if they needed metal, they could just call a dealer and get it. Musk's tweet tells them that trust is gone. He is looking at the same data we are, the inventory cliff, the deficit, the China news, and he is realizing that just in time is about to become not in time. So what happens next? Samsung reads that tweet. They panic. They call the refiner and say, "Double our order for 2026. No, triple it. And store it in our vault, not yours." Now Apple reads that tweet. They panic. They secure strategic reserves. This creates an inventory hoarding cycle. It is exactly what happened with toilet paper in 2020, but with a strategic metal that runs the global economy. Everyone tries to buy it once, not to speculate, but to ensure they can keep the lights on. And when industrial giants start hoarding, the quotation creates a vacuum. They don't bid up by cents, they sweep the order book. And they buy everything at $79, everything at $85, everything at $90. This is why we hit $79.57 today. The market is front-running the inevitable corporate panic. The algorithms know that Musk doesn't tweet about commodities unless there is a material problem. They know that he has the best supply chain intelligence in the world. If he sees a shortage, there is a shortage. And let's be honest, Musk isn't just an observer, he is a catalyst. Remember when he put Bitcoin on Tesla's balance sheet? What happened? Bitcoin doubled in weeks. We are hearing rumors, and his tweet supports this, that Tesla may be looking to secure a direct stake in silver mining production or physically stockpile the metal to hedge against the shortage. If that news drops, if we get a filing that Tesla has bought physical silver, $100 is not the target. $100 is the floor. So the $79.57 all-time high is not a bubble. It is the market waking up to the fact that the quotation has been too low to incentivize new supply for decades, and now the users are paying the cost. Silver has been treated like a paper toy for 40 years. Today, it reclaimed its status as a critical strategic asset. The quotation is rising because the people who actually need it are realizing that the people who sell it, the paper markets, have been lying about how much they have. But here's the scary part. Musk's panic isn't just about general supply deficits. He isn't just looking at the mining charts and doing the math. He is looking at a specific date on the calendar, a date that is less than 4 days away. He knows something that the mainstream media is ignoring. He knows that on January 1st, 2026, the single biggest disruption to the silver market in history goes into effect. He knows that the largest producer of refined silver in the world is about to lock the gates. Musk's tweet was a reaction to this specific news. He knows that the China export license system is not just a bureaucratic rule change, it is a blockade. And when you understand the details of what China is about to do, the specific thresholds, the credit requirements, the nationalization of supply, you will understand why Elon Musk is worried. And you will understand why $79 silver is a gift. Because what is happening in Beijing right now is the checkmate move against the Western industrial complex. They aren't just tightening the market, they are capturing it. And that brings us to the details of this new policy, because the fine print is absolutely terrifying for anyone who needs silver outside of China. This brings us to the specific nightmare that is keeping Elon Musk awake at night. It isn't just a vague feeling that mines are running dry. It is a specific hard deadline that hits the global supply chain in exactly 4 days. On January 1st, 2026, the rules of the game change forever. China, the world's largest refiner and processor of silver, is officially implementing a new export licensing system for silver. Now, usually when you hear export license, you think of boring paperwork. You think of bureaucrats stamping forms. But do not be fooled. In the language of the Chinese Communist Party, export license is a polite synonym for blockade. We have analyzed the fine print of this new regulation, and it is designed to do one thing: strangle the global market while hoarding the domestic supply. Here are the requirements that go into effect next week. To qualify for a license to export silver out of China, a company must now prove 2 things. First, they must have an annual production capacity of at least 80 tons. Second, they must have established credit lines of approximately $30 million US. Now, why do these specific numbers matter? Because they are a guillotine. They are designed to sever the head of the small and mid-sized export market. Hundreds of smaller refineries, trading houses, and independent brokers who used to supply the West with silver are instantly disqualified. They're too small. They don't have the volume. They don't have the credit lines. Overnight, they are banned from selling their metal to Apple, to Tesla, to Samsung. So where does their silver go? It can't leave the country, so it stays in China. It floods the local Shanghai market. It goes directly to BYD, to cattle, to the Chinese solar giants. This is a calculated act of resource nationalism. China is effectively saying, we produce the solar panels. We produce the EV batteries. We need the silver. Why should we let you export our strategic advantage to the West? This is the exact same playbook they used with rare earth metals a decade ago. They tightened export quotas, crushed the foreign competition, and forced every major tech company to move manufacturing to China if they wanted access to the raw materials. Now they are doing it with silver. And the timing's not accidental. They are doing it right as the global deficit hits critical mass. They are closing the door just as the building catches fire. Elon Musk sees this. He knows that China controls a massive percentage of the refined silver supply chain. Even if the ore is mined in Mexico or Peru, much of it flows through Chinese smelters and refiners. If that flow stops, the global supply chain snaps. China controls roughly 60-70% of the global refined silver processing capacity. When they restrict exports, the global quotation becomes a myth. There will be 2 quotations. The quotation inside China, where there is metal, and the quotation outside China, where there is panic. This is why the arbitrage we talk about is dead. Western traders used to say, oh, if silver is expensive in London, we will just buy it in Shanghai and ship it over. Not anymore. You can't ship it over. You don't have the license. You aren't a state-approved entity. The metal is trapped. This creates a physical iron curtain. On one side, China's industrial machine gets priority access. On the other side, Western industry, Musk's industry, is left fighting for scraps in a market that just lost its biggest supplier. This is why the $79 quotation is just the beginning. The market is trying to account for a supply shock that hasn't even officially started yet. January 1st is the start date. What happens in February when a US electronics manufacturer tries to order their usual shipment from a Chinese supplier and gets a force majeure notice? What happens when they realize they can't get the metal at any quotation because the government won't issue the stamp? They will turn to the COMEX, they will turn to London. But as we know, those vaults are already being drained. So the Chinese export ban forces all the Western demand into the Western vaults, which accelerates the squeeze. It concentrates the panic into New York and London. It turns a shortage into a crisis. And you have to ask yourself, why now? Why January 1st, 2026? Because China sees the numbers too. They see the deficit. They see that global demand is hitting 1.24 billion ounces while supply is stuck at 1.01 billion. They see the gap of 250 million ounces. They know that in a deficit, he who holds the physical metal wins. They are securing their lifeboat before the ship sinks. They are ensuring that no matter how high the quotation goes, their factories will keep running. This is what Elon Musk meant by, "This is not good." He isn't worried about the quotation on a chart. He is worried about the factories in Texas and Berlin stopping because they can't get the conductive paste they need. He is realizing that the free market for silver is gone. It has been replaced by a state-controlled market where access is a privilege, not a right. And this leads us directly to the fundamental reality that the financial world has ignored for too long. For decades, Wall Street told us silver was just a volatile rock. They told us it was a pet rock. They told us it didn't matter. But the industrial data tells a different story. The data tells us that silver is the oxygen of the modern economy. And right now, the supply of oxygen is being cut off by the one country that controls the valve. We need to look at the industrial reality of this market because the structural deficit isn't a theory. It is a mathematical certainty that is about to collide with this export ban in the most violent way possible. And you have to understand, China's export ban is just the match. The pile of dynamite has been building for 5 years. Even before China decided to nationalize their supply, the global silver market was mathematically broken. We need to talk about the structural deficit because this is the data point that turns Elon Musk's "this is not good" tweet into a prophecy. For the last 5 consecutive years, the world has consumed more silver than it has produced. This isn't a temporary glitch. It isn't a supply chain bottleneck caused by a ship stuck in the Suez Canal. It is a geological reality. In 2025 alone, global demand for silver surged to 1.24 billion ounces, but global mining supply? It flatlined at 1.01 billion ounces. Do the math. That is a gap of nearly 250 million ounces in a single year. Where did that extra silver come from? It came from above ground stockpiles. It came from the vaults in London and New York. It came from recycling. But you can only drain a bathtub for so long before you hit the porcelain. And right now, we are scraping the bottom. Now, usually, when a commodity gets too expensive, the market finds a substitute. If copper gets too expensive, builders switch to aluminum piping. If platinum gets too pricey, car makers switch to palladium for catalytic converters. Wall Street assumes the same thing will happen with silver. They think, oh, if silver hits $100, Tesla will just use copper. They are wrong. And this is where the physics comes in. Silver is not just a shiny metal. It is the single most electrically conductive element in the known universe. It conducts electricity better than copper. It conducts better than gold. It has the highest thermal conductivity and the highest optical reflectivity of any metal. In the world of high-efficiency electronics, in the world of EV batteries, 5G towers, and advanced solar panels, you cannot compromise on conductivity. If Elon Musk switches the contacts in a Tesla battery from silver to copper, the efficiency drops, the range decreases, the heat increases, the car becomes worse. If a solar panel manufacturer switches from silver paste to copper paste, the panel generates less power. In the race for energy dominance, good enough is not an option. You need the best. And the best is silver. This is why industrial demand now makes up 50-60% of the entire silver market. Think about that shift. 50 years ago, silver was for photography and silverware. It was a precious metal. Today, it is a strategic mineral. It is the DNA of the green energy revolution. You cannot have the Green New Deal. You cannot have net zero. And you cannot have the AI revolution without consuming billions of ounces of silver. And this brings us back to Musk. He isn't just buying silver for jewelry. He is buying it because his entire business model depends on it. Tesla and Solar City are massive consumers of silver. Every time they sell a Model Y, they are selling silver. Every time they install a solar roof, they are installing silver. Musk knows that he is effectively the world's largest naked short on physical silver. He has sold millions of cars and panels that will need silver in the future, but he hasn't mined the metal yet. So when he sees China, the country that refines the vast majority of the world's silver, locking the gates on January 1st, he realizes that his supply chain is naked. He realizes that the 250 million ounce deficit is about to become a 400 million ounce deficit because the Chinese supply is no longer available to the West. This transforms the buyer psychology. For the last decade, industrial buyers were price sensitive. If silver went up, they bought less. Now, they are price inelastic. If you need silver to finish a $50,000 electric car, you don't care if the silver costs $25 or $100. The cost of the silver is a tiny fraction of the total vehicle cost. But without it, the vehicle doesn't run. You will pay any quotation to get the metal. It is about chief procurement officers at Samsung, Apple, and Tesla screaming at their suppliers to secure metal before their competitors do. It is a game of musical chairs, and China just removed half the chairs. And here is the most dangerous part for the financial system. While the industrial demand is exploding to 1.24 billion ounces, the paper market, the futures market in New York, is still pretending that silver is abundant. They are trading hundreds of times more paper than actually exists in the vaults. They have built a casino on top of a mine that is running empty. We have a specific number for this insanity. It is called the paper to physical ratio. And right now that ratio sits at 3, 5, 6 to 1. That means for every single ounce of real silver sitting in a vault, there are 356 people holding a piece of paper that claims to own that ounce. What happens when Elon Musk and Samsung and Apple decide they don't want the paper anymore? What happens when they demand the physical metal because they need to put it into a factory? The 356 claims collapse into one. 355 people get nothing. One person gets the metal. This is the death of paper scenario. And with the China export ban starting in 4 days, we are about to see exactly what happens when the paper promises collide with the physical wall. In the next part, I'm going to break down this 356 to 1 ratio and explain why the COMEX is effectively a fractional reserve crime scene that is about to be exposed by the industrial giants. The paper market is dying, the physical market is taking over, and the quotation is about to reflect reality. And if you think the physical deficit is terrifying, you need to look at the paper market, because this is where the crime scene is located. This is where the greatest illusion in financial history is about to be shattered by the brute force of industrial necessity. We have a specific number that defines this illusion. It is the paper to physical ratio. And right now, according to the latest data from the US Debt Clock and industry analysts, that ratio sits at approximately 3, 5, 6 to 1. I want you to really visualize what that number means. Imagine a warehouse with a single 1-ounce silver coin sitting on a table in the center of the room. Now imagine a line of 356 people standing outside that warehouse. Every single one of those people holds a piece of paper. That piece of paper says, I own 1 ounce of silver stored in this warehouse. They all paid for it. They all believe they own it. The bank told them it was there. For 40 years, this Ponzi scheme worked perfectly. Why? Because the holders were hedge funds, high-frequency traders. As long as they traded the paper back and forth, the bank could collect fees and pretend the system was solvent. It was a game of musical chairs, where the music never stopped, so nobody noticed there was only one chair. But today, the music didn't just stop. Elon Musk walked into the room and smashed the speakers. When Musk tweets this is not good regarding supply, and when China locks its export gates, the psychology of the market shifts instantly from speculation to possession. Suddenly, those 356 people aren't just gamblers. One of them is Tesla, one of them is Apple. They want the coin. They need the coin to build the missile, the phone, the car. What happens to the other 355 people? What happens to the pension funds, the retail investors, the ETFs that are holding paper claims on an asset that just left the building in a Tesla truck? Their paper goes to zero. Or more accurately, it cash settles. Here's a check for the last traded quotation of $79. But here's the catch. You can't buy silver for $79 anymore because there is none left. The real quotation in the street, the quotation Tesla paid, might be $200. But you get a check for $79. You get robbed in broad daylight. And we are seeing the early tremors of this right now. Look at the inventory data. The COMEX registered inventories, the metal actually available to back these paper claims, are down 70% since 2020. The London vaults are down 40%. The buffer is gone. We have burned through the stockpiles that allowed the banks to suppress the quotation for decades. At current demand rates, some regions hold only 30 to 45 days of usable silver. 30 days, that is nothing. That is one bad shipping month. This is why the quotation is moving vertically. It is not inflation. The smart money is rushing to convert their 356 paper claims into the 1 real ounce before it's too late. They are rushing to get a chair before the music fades out completely. And this disconnect explains why the banking system is so terrified of Elon Musk. If Musk decides to bypass the COMEX, if he goes directly to a miner in Mexico and buys the entire year's production, he removes that supply from the paper market. He makes the ratio worse. If he buys 10 million ounces, he creates 3.56 billion ounces of unbacked paper demand in the futures market. Mathematically speaking, by removing the collateral, he exposes the fraud. But you cannot print physical conductivity. You cannot print a solar panel. The industrial user is the audit that the banks can't cheat. And right now, the auditor is knocking on the door, and he brought a fleet of trucks. This reality, the 3-5-6-to-1 leverage, is why I tell you that $79 is cheap. If the paper market fails and we move to a 1-to-1 pricing model where quotation is determined by actual physical supply and demand, what is the quotation of silver? It certainly isn't $79. In a 1-to-1 world where silver is as scarce as the geology dictates and vital to the entire tech economy, the quotation has to ration demand. It has to go high enough that Apple decides not to make an iPhone. What quotation is that? We don't know, because we have never had a free market in silver. We have had a manipulated paper market for our entire lives. It is found in the one place where the paper market has already lost control. It is found in the physical premiums being paid right now in the East. While New York traders are swapping paper contracts at $79, the real metal in Shanghai is trading at a completely different level. The arbitrage is dead, and the Shanghai premium is the ghost of the future visiting us in the present. Let's look at exactly what is happening in China's physical market, because that is where the $100 quotation is already becoming a reality. That number is a synthetic derivative generated by a computer in New York that assumes infinite supply. If you want to know the real quotation of silver, the quotation that industrial powerhouses are actually paying to secure physical metal, you have to look east. While New York traders are high-fiving over $79, the physical market in China has already crossed the Rubicon. According to the latest data from the Shanghai Gold Exchange and the local physical premiums, silver is trading at $84 plus per ounce. This is Finance 101. If silver is $79 in New York and $84 in Shanghai, a bank would simply buy it in New York, fly it to Shanghai, sell it, and pocket the risk-free $5 profit. This is called arbitrage. It is the mechanism that keeps global quotations aligned. It is the gravity of the financial world. But the arbitrage isn't happening. Why? Because of the export licenses. They know that once the metal enters China, it can't leave. The Chinese are hoarding. So the mechanism that usually equalizes the quotation, the flow of metal from low quotation to high quotation, has been severed. This means we are witnessing the bifurcation of the global silver market. We are seeing the world split into two distinct quotation zones. Zone A is China. High quotation, physical availability for now, strictly controlled by the state. Zone B is the West London, New York, lower paper quotation, rapidly depleting inventory, and total panic among industrial users. This gap, this Shanghai premium, is the ghost of Christmas future for the American investor. It is telling us exactly where the quotation is going. The quotation in Shanghai is higher because the need is higher and the reality is closer. They are closer to the manufacturing base. They know the supply constraints better than the guys in Manhattan. If they are paying $84 plus, it's because they know $84 is cheap. Buyers in Shanghai are paying extra just to get real silver. They're paying a premium to jump the line. When you see a premium like this explode, it is the market screaming that the spot quotation is invalid. The spot quotation is the quotation for a contract that might settle in cash. So when you look at your screen and see $79.11, do not think, oh, it's expensive. Think, it is trading at a discount to reality. I can buy this asset in New York for $5 less than it is worth in the world's largest manufacturing hub. That is not a bubble. But the window to buy at this discount is closing fast as the Western vaults drain. As we discussed with the 70% drop in COMEX inventory, the Western quotation will have to snap up to meet the Eastern quotation. It's like a rubber band stretching. New York is down here, Shanghai is up there. Eventually the rubber band snaps, and when it snaps, New York doesn't just drift up to $84. Because once the panic moves from Shanghai to New York, once Elon Musk starts buying COMEX bars instead of Chinese bars, the scarcity in the West becomes acute. This is the vacuum we are entering. The China export ban on January 1st effectively isolates the Western market. It cuts us off from the world's biggest refiner. So the COMEX is now an island. This isolation is why the paper market death spiral is accelerating. Traders in New York realize that they can't hedge their positions with Chinese metal anymore. If you are short silver in New York and you get squeezed, you used to be able to call a refinery in China and say, send me 50 tons. Now you can't. The license system stops you. You're trapped in your short position with no physical escape route. This makes every short position in the West infinitely more dangerous. It creates the conditions for a super squeeze where the quotation has no ceiling because there is no incoming supply valve to release the pressure. The $84 plus quotation in Shanghai is the industrial floor. It is the quotation that the actual users of the metal have agreed is fair value for survival. And when it does, it usually happens overnight. You wake up and silver's up $10 because a major bank failed to deliver and had to settle at the Shanghai quotation. If you can buy physical silver today at a quotation closer to the COMEX spot than the Shanghai premium, you are winning. You're arbitraging the stupidity of the Western banking system before it collapses. You're buying the unobtainium while it is still valued as a pet rock. And this brings us to the final realization. If China is hoarding, and if Musk is panic buying, and if the paper market is leveraged 3, 5, 6 to 1, then $79 isn't the top. $79 is the launch pad. We are looking at a scenario where the quotation must rise high enough to force people to sell their jewelry. It must rise high enough to make recycling profitable. It must rise high enough to balance a market that has been broken for decades. In the final part of this report, I'm going to tell you exactly where that quotation level is. I'm going to give you the industrial floor quotation target not based on charts, but based on the cost of failure for companies like Tesla. The $100 target is no longer a meme. It is the new base case. The industrial reset is here. The paper era is over. Based on the trajectory of the industrial panic and the Shanghai divergence, we arrive at the final inevitable conclusion. The $100 quotation target is no longer a moonshot. It is the conservative mathematical output of a market that has run out of physical metal. We have spent this entire report breaking down the mechanics of the squeeze the Musk signal, the China blockade, the structural deficit, the death of paper arbitrage. But now we need to talk about the quotation. If you're waiting for a pullback to $25, you're waiting for a world that no longer exists. You're waiting for a world where China exports freely, where mines produce a surplus, and where Elon Musk ignores his supply chain. We are establishing a new floor, and I am going to make a bold call right now. $100 is the new industrial floor. Now, I know that sounds aggressive. We are at $79 today. $100 seems far away. But you have to look at this through the eyes of the industrial buyer, not the retail speculator. To a retail investor, silver going from $30 to $100 feels expensive. It feels like a bubble. But to an industrial user like Tesla or Samsung, the difference between $30 silver and $100 silver is a rounding error on their balance sheet. If silver is $30, the cost of the metal in that $50,000 car is $30. If silver goes to $100, the cost of the metal in that $50,000 car is $100. Does a $70 increase in the cost of raw materials stop someone from buying a Tesla? No. This physical reality is what sets the stage for the next phase of the crisis. Because as the banks bleed cash to find metal, the stress transmits to the broader financial system. The repo spike is just the first crack in the dam. Because you have to ask yourself, why would the Federal Reserve, the most powerful economic institution on earth, care about a few $1 billion lost on a shiny metal? Why would they debase their own currency and risk their credibility to save a handful of trading desks from a bad bet? The answer lies in the terrifying architecture of the modern financial system. And we're not living in a world of separate siloed markets anymore. We are living in a world of daisy-chained leverage where every asset class is inextricably linked to every other asset class through the dark magic of derivatives. The mainstream media treats silver like a niche asset. They call it a commodity. But to the banks, silver is not a commodity. It is a financial collateral tier. It is a foundational block in a tower of rehypothecated value. The banks didn't just sell paper once. They leased it, swapped it, bundled it, and used it as collateral to borrow money to bet on treasuries or yen or tech stocks. This is the contagion nightmare that woke up the Fed governors this morning. If a major bullion bank, let's call them Bank X, cannot meet a margin call on silver, they default to the COMEX clearinghouse. The moment that default happens, the clearinghouse has the legal right to seize all of Bank X's collateral. That means they seize their treasury bonds, they seize their corporate bonds, they seize their cash. Now imagine Bank X is also the counterparty for $1 trillion in interest rate swaps with a pension fund. Suddenly, Bank X is frozen. The pension fund can't hedge its risk. The pension fund panics and sells bonds. The bond market crashes. When the bond market crashes, the collateral for the other banks loses value. Now, Bank Y gets a margin call. It is a domino effect. It is 2008 all over again. But this time, the toxic asset isn't subprime mortgages. It is a naked short position in a strategic metal that is in a physical shortage. The Fed stepped in with that $17 billion because they looked at the internal risk monitors and saw the red zone. They saw that a failure in the commodities division of a GSIB Global systemically important bank threatened to lock up the repo market for everyone. They realized that the silver squeeze wasn't just squeezing the shorts, it was squeezing the liquidity of the entire US banking sector. They had a binary choice, and it is the same choice they have faced in every crisis since 1987. Choice A: allow the free market to function. Let the banks who manage their risk poorly fail. Let the shareholders get wiped out. Let the quotation of silver reset to $200 overnight, creating a chaotic but honest market. Choice B: intervene. Print the money, provide the liquidity, save the banks, but destroy the signal. They chose choice B. They always choose choice B. They chose to sacrifice the integrity of the dollar to save the structure of the banks. But here is the fatal flaw in their logic. Here is the doom loop that they have just trapped themselves in. By printing $17 billion to bail out the system from a silver squeeze, they have just poured jet fuel on the inflation fire. Think about the signal this sends to the rest of the world. The US dollar is supposed to be the risk-free asset. But today, the Fed admitted that the banking system backing that dollar is so fragile that a $5 move in silver threatens its solvency. They admitted that they have to print money to prevent a deflationary bust. What happens when you print money? The currency devalues. What happens when the currency devalues? Hard assets go up in quotation. What happens when hard assets go up in quotation? The bank's short positions get worse. Do you see the trap? The very act of saving the banks makes the silver quotation go higher. To save them today, at $77, they printed $17 billion. That printing will push silver to $85 next week. So next week, they will have to print $25 billion. The printing will push silver to $95. It is a self-defeating feedback loop. They are trying to put out a fire by smothering it with cash, but cash is flammable. They're caught in a liquidity trap of their own making. They cannot stop printing because the system will collapse. But they cannot keep printing because the currency will collapse. And the market knows this. The smart money, the real smart money, not the hedge fund guys borrowing SLV, but the macro allocators who run sovereign wealth funds, they are watching this repo spike. And they are terrified. They realize that the Fed put has shifted. For 20 years, the Fed put was under the stock market. If stocks crashed, the Fed printed. Today, the Fed effectively placed a put under the silver quotation. By bailing out the shorts, they have capped the downside. They have proven that they will provide infinite liquidity to the system to prevent a blowout. This means that if you own silver, the Central Bank of the United States is effectively subsidizing your risk. If the quotation drops, the physical shortage takes over. If the quotation rips and breaks the banks, the Fed prints money, causing inflation, which drives the quotation back up. It is a heads I win, tails you lose scenario for the silver holder. This realization is what drove the 50% gains in the junior miners today. The equity market is a forward-looking machine. It is valuing in the pivot. The Fed hasn't held a press conference. Jerome Powell hasn't stood at the podium. But actions speak louder than words. A $17 billion emergency repo operation is the pivot. It is the restart of QE infinity in everything but name. And we have to talk about what this means for the too big to fail concept. By tapping this facility, the bullion banks have effectively become wards of the state. They are no longer independent capitalist entities. They are zombie utilities kept alive by the state to facilitate the flow of credit. This means that the suppression of the silver quotation is no longer a private conspiracy. It is a state-sponsored operation, but it is a failed operation. History is littered with examples of governments trying to peg the quotation of commodities. The London gold pool in the 1,960 seconds, the Nixon price controls in the 1,970 seconds. Every single time, the market wins. Every single time, the physical reality overwhelms the paper mandate. The London gold pool collapsed in 1968 when the run on gold drained the vaults. We are watching the New York silver pool collapse in 2025 as the run on silver drains the COMEX. The mechanism is identical, the hubris is identical, and the outcome will be identical, a violent, chaotic repricing of the metal to a level where the demand matches the supply. And the contagion isn't just financial, it's psychological. Trust is the currency of the banking system. When a bank taps the repo facility, trust evaporates. Other banks stop lending to them. Counterparties demand higher margins. This tightens financial conditions across the globe. This is why we saw the dollar index, DXY, tank today despite the flight to safety narrative. Usually in a crisis, the dollar rises. But today, the dollar fell. Why? Because the market realized the crisis is the dollar itself. The crisis is the solvency of the issuers of the dollar. Investors are looking at the US debt $38 trillion and counting. They are looking at the interest payments $2 trillion a year. And now they are looking at the Fed printing money to bail out commodity speculators. They are connecting the dots. They're realizing that the only way out of this debt trap is to inflate it away. Silver is the only lifeboat that cannot be diluted. You can dilute the dollar. You can dilute the euro. You can even dilute Bitcoin with forks and thousands of altcoins. But you cannot dilute silver. It is atomic element number 47. It is forged in supernovas. There's a fixed amount on the crust of the earth, and we have already mined the easy stuff. So the contagion spreading through the banks is actually the antibodies of the free market attacking the virus of fiat currency. The system is trying to heal itself. The fever of high quotations is the cure. High quotations stimulate supply and ration demand. The Fed is trying to suppress the fever, but the patient is too sick. And this brings us to the geopolitical angle of the contagion. Do you think Beijing didn't see that repo print? Do you think Moscow missed it? They are watching the US banking system bleed. This validates their strategy. It encourages them to press the advantage. If you know your opponent is illiquid, if you know they are desperate for cash, do you ease up? No. You double down. You buy more physical metal. You tighten the blockade. You squeeze them until they break. The $17 billion today didn't just save a few banks. It signaled weakness to America's geopolitical rivals. It told them that the US financial shield is cracked. This guarantees that the war on shipping and the war on commodities will escalate. China knows that if they can keep the quotation of silver above $80 for another week, they can force the Fed to print another $50 billion. If they push it to $90, maybe they can force $100 billion. They can force the US to hyperinflate its own currency just to keep the banks alive. It is financial warfare 101, and the Fed just walked right into the trap. So as we transition to the final part of this report, you need to understand that the $100 quotation target isn't just about charts or supply deficits anymore. It is about a fundamental shift in the monetary regime. We have crossed the Rubicon. The Fed is now the buyer of last resort for the bank's bad silver bets. And because the Fed has infinite dollars but zero silver, the quotation of silver has to rise to infinity in dollar terms to balance the equation. The $17 billion was the all-in moment. The Fed pushed its chips into the center of the table. But the market holds the royal flush. The market holds the physical metal. And in the final part, I'm going to tell you exactly how to play this hand. I'm going to give you the roadmap for the inevitable move to triple digits and how you can position yourself to be on the receiving end of the greatest wealth transfer in history rather than the victim of it. The Fed pivot is here, the game has changed, and the quotation is about to reflect the new reality. The $17 billion wire transfer was the all-in moment. The Federal Reserve pushed its chips into the center of the table, but the market holds the royal flush. The market holds the physical metal. And the Fed holds nothing but a printing press that is rapidly losing its power to command respect. We have arrived at the conclusion of this report, but really, we have arrived at the beginning of a new monetary epoch. The events of this morning, the panic in the repo market, the capitulation of the shorts in SLV, the record-breaking delivery demands have confirmed the one thing that every gold and silver investor has been waiting for: the pivot. For 2 years, the mainstream financial media has obsessed over the pivot. They asked, when will Jerome Powell cut rates? When will they stop tightening? They thought the pivot would come with a press conference. They thought it would come with a polite adjustment to the dot plot. They were looking for a ceremony. Instead, the pivot arrived in the dark. It arrived as a desperate $17 billion liquidity injection to save a banking system that is choking on its own leverage. This is the pivot. When the central bank is forced to print money to prevent a systemic collapse caused by a commodity squeeze, the tightening cycle is mathematically over. They cannot fight inflation and bail out the banks at the same time. They have chosen the banks, and by choosing the banks, they have surrendered to inflation. This changes the calculus for silver entirely. We are no longer just looking at a supply-demand deficit. We are looking at a currency devaluation event. The Fed put that magical safety net that investors believe protects the stock market has now been placed firmly under the silver quotation. Think about the implications. If silver crashes tomorrow, the bank's collateral problems might ease temporarily, but the underlying physical shortage remains. The squeeze just rebuilds. But if silver rips higher, which it is doing, the banks face insolvency, and the Fed is forced to print. This printing devalues the dollar, which makes silver a dollar-denominated asset go even higher. The Fed has inadvertently created a mechanism where their own survival reflex pushes the quotation of precious metals to the moon. They are trapped in a room with shrinking walls. To save the system, they must destroy the currency. And as the currency is destroyed, the nominal quotation of real things must rise to infinity to compensate. This is why my quotation target of $100 is no longer a speculation based on industrial usage or mining deficits. It is a policy certainty. It is the mathematical output of the equation the Fed just wrote. If they have to print hundreds of billions, eventually trillions, to keep the repo market liquid and the derivatives complex from detonating, then silver at $100 is actually cheap. In a hyperinflationary liquidity cycle, $100 is the new $20. So what is the roadmap for the next few weeks? How do we navigate this endgame scenario? First, you must understand that the volatility will be extreme. The beast is wounded, but it is not dead. The banks, armed with their fresh $17 billion of Fed liquidity, might try one last desperate smash. They might try to use that cash to short the market into oblivion on Monday morning to break the psychology of the retail investor. Do not let them. If you see the paper quotation drop $10 in a flash crash, do not panic. Smile. Realize that this is the death throes of a broken system. Realize that every time they smash the paper quotation, they're just making the physical metal cheaper for China, for India, and for the savvy investors who are draining the vaults. A paper smash and a physical shortage is like putting a sale sign on an empty shelf. It doesn't create inventory. It just accelerates the panic. Second, watch the basis. The basis is the difference between the futures quotation and the spot quotation. In a healthy market, futures trade higher than spot, contango. In a shortage, spot trades higher than futures, backwardation. We are already seeing backwardation in the near months. When you see the spot quotation rip away from the futures quotation, when you see dealers charging $10, $15, $20 over spot, that is the real quotation. The screen quotation is a lie. The street quotation is the truth. Follow the truth. Third, and most importantly, prepare for the unobtainium phase. We are very close to the moment where the major dealers simply run out of stock. The 12,776 delivery notices are sucking the wholesale market dry. Once the wholesalers are empty, the retail shelves go bare. The buy button will disappear. When that happens, the quotation will effectively become infinity for anyone who isn't already holding. You won't be able to get in. The doors will close. We are seeing early signs of this already, with delays stretching to February for certain sovereign coins. If you are sitting on cash waiting for a dip, you're playing Russian roulette with a fully loaded gun. The risk isn't that you buy too high. The risk is that you can't buy at all. This brings us to the final strategic conclusion. We are witnessing the greatest wealth transfer in history. But wealth is not destroyed, it is merely transferred. It is transferring from those who hold paper promises, bonds, currencies, derivatives to those who hold real things. For 40 years, the flow went one way from the real to the financial. The financial economy cannibalized the real economy. Now the tide has turned. The real economy is devouring the financial economy. The miners, the stackers, the holders of physical assets, you are the new captains of capital. The banks are insolvent. The Fed is trapped. The vaults are empty. The war is escalating. The shorts have fled. The stars have aligned in a way that happens once in a century. Do not sell your position for fiat currency that is being printed to bail out your enemies. Hold the line. When silver hits $100, do not sell it for dollars. Leverage it. Borrow against it. Trade it for land. Trade it for business. But do not trade it back into the burning building of the fiat system. The $17 billion signal this morning was the flare gun. It lit up the night sky and revealed the battlefield. And what we saw was a banking system in full retreat. They have abandoned the fortress of sound money. They are burning the furniture to stay warm. You have the metal, you have the position, you have the patience. The game is rigged, yes. But for the first time in history, it is rigged in your favor. The Fed has guaranteed your upside by guaranteeing the inflation needed to save the banks. The ghost week is ending. The reality is beginning. The $100 wave is unstoppable, and you are riding it. I am John from Currency Archive on YouTube. Like, subscribe, and share the message. Claude is AI and can make mistakes.